Yeah, well, good afternoon, everybody. I hope you're all hearing me. If you don't, do send me a message. We can try and find out what's happened. Welcome to our first webinar. It's great to see some familiar names on the list here that help sharing with us listening. So I also would like to especially welcome people from Finder.com who send us inquiries. Thank you, and thank you for bearing with us while we respond to your queries. Now, look, today's presentation is on capital gains, as we've said, but of course it is capital gains for property investors, and we're trying to point out how to avoid the hidden pitfalls overall. So the way to start with that, well, before we go on, I suppose I better introduce myself. So for those of you who are already who are new to our presentations, look, my name is Shukri Barbara. I'm a chartered tax advisor. That just means I'm a 30-year member of the Tax Institute, and I'm also a CPA. Now, early in the year, we were also the readers of Your Investment Property magazine voted us the best property tax specialist of the year. So I appreciate your support where you've done that for us. Now, also to explain what do we do at Property Tax Specialists, we have a focus on people with investments in property, and we help advise people and structure ownership of property to really minimize tax, legally of course, maximize their returns and protect their assets as necessary. But we also like to keep the ATO happy because the ATO is quite aggressive at the moment, particularly with their enhanced IT capability. All of this, keeps them happy. So unless you're a Google or an Apple or a Microsoft, it's good to work with the ATO. We also do other things like tax returns, cash flows, preparing cash flows, just analysing various helps to get you on the road in making decisions overall. Now, today's objective is really to, with the limited time we have, is just to create an awareness so that you can ask the right questions, but more importantly, to make informed decisions. So if you don't know what to ask, it's very hard to get the information. Before we start, I'll just let you know about the standard disclaimer. Look, the information today is of a general education nature only. Because we don't know your specific circumstances, you should act on it. You should not act on it without any specific advice from your advisor. We're happy to help out in advising. You let us know where we can do it. Now, most of us know that CGT was introduced by the Hawke-Keating government in September 1985. But did you know how CGT was taxed before that date? Well, the answer is simple. It wasn't taxed. Now, those of you who remember Alan Bond during the 80s, he structured most of his deals to come up with no taxable income because it's supposed to be a capital gain. And really, it just was not taxed. So after September 1985, the government tried to tax what they called the real gain, that is, after inflation. So what we have after inflation is they used to get us to do measure it through the index. So the price would have been, say, 100,000 at index 1. In a couple of years, if the index moved to 3, then the difference between 1 and 3, and we increased the price. That's what they wanted to tax. It was a very complex arrangement, and it took time. It took really a very long time to work it. So Mr. Costello and Mr. Howard came up with the idea of just giving us a flat discount of 50% to allow for that. Now all the economists are complaining about that, and they're saying, well, listen, how about we pull back that 50% so that the budget is, again, in surplus. I don't know that that's going to happen anytime soon, so I don't think you should worry about that, at least not for this coming election. Now, while CGT applies on all the assets, there are a few exemptions mainly for smaller things, right? But generally, capital gains applies on just about everything. Now, some of the smaller exemptions, really, they just want to take out things like personal use assets, which include things like boats and furniture, things less than $10,000. Collectibles like jewelry and art, cars, shares in pool development. Now, compensation for occupational injury. So if you get injured, of course, nobody really wants to get injured in the first place. And if you win on the horses, now there's always disputes between the tax office who wants to prove that you're a gambler and you're carrying on the business of gambling, or it was just luck. And there are other few bits and pieces, but they're not quite as relevant. But today's focus really is CGT on property. Before we can get to property, to work out how to avoid the various pitfalls, we have to understand how it works, how capital gains works, right? It really basically is the difference between your sale price, which you can easily find on your contract of sale, and what we call the cost base. Not what we call, really, what's called in the legislation is the cost base. But what does the cost base really involve? That's pretty important, because when that moves, you get a different capital gains. So at the end of the day, cost base includes the following: the purchase price, the buyer's agent's fees as part of that, the stamp duty that you pay, the legal fees both on purchase and on the sale, the selling agent's fees, you've got inspections or the pest and building all relating to that property, and of course renovations. As soon as you buy it, if you renovate immediately, or if you have even initial returns, for example, cleaning the carpet, or painting, etc., that's all going to be considered part of your cost base. It's not going to be deductible, because it's considered that the lower price of the property is already reflected in that. So you won't really get that. Now, look, let's do a little poll. We're just going to get you involved a little bit. So if you bear with me, this is a bit of a technological sort of change for me here. So we're going to put a few questions up, or this question is going to come up, and we're going to ask you to see how closely you get it. Let's say we get a rental property, was purchased for about $400,000 in 2012, and after purchase, the following renovations were made. Well, repairs or renovations, really. It's repairs for some of them. So we've got plumbing, we've got electricals, we replaced the fly screens, we painted the walls, we replaced the window screens, and so forth. Now the question is going to be, which cost will be included in the cost base? Now we're going to run this exercise, and I'm being pointed to where the polls are, so I'm going to print on this one, open it up. Okay, did we get it? Where's the polls here? Sorry, everybody, just bear with me. Yes, I've found it. Here it is, and we're going to launch it. I'll give you about half a minute to do it. This is a really easy one. If you can see it, we can see how many of you are going to answer on that one. Okay, we've got about 100%, so we'll close it at this point. Okay, and we have to share the screen back with you. Yes, all right, and the answers, of course, is going to be, sorry, here we are. The answer, of course, is going to be all of them. They're all part of your cost base. Why? Because it's all been incurred straight after the purchase. Now, a lot of people ask me the questions of these things. There are a couple of things that can't be included as part of the cost base. The first one is travelling. There's a lot of people who travel to Queensland and other locations to inspect these properties before purchase. Now, the cost of that is just not deductible, because you haven't really owned the property yet. So it cannot be part of your cost base. The other part is going to be legal, inspection and other costs incurred when you don't actually sign on the contract, because you might take the trip, you might go up there, you might have prepared, and for some reason you've got a disagreement with the vendors, then that can't be part of the cost base. So it's just thrown into the black hole sort of definition that goes in there. The next thing is we're looking at is building depreciation. That the cost base figure is affected by depreciation claimed as a deduction because at the end of the day you've got the building. Well, let's just talk about depreciation for a minute. You've got building is deemed to have 40 years life generally if it's constructed after 1985, or even the renovations. If the renovations are worth more than 75, I think there is an index. It started out at 50,000, but it's indexed upwards now, and it's considered a separate asset if the actual property was purchased before 19th of September 1985. Now, the building is deemed to have a 40-year life, and that means 2.5% annual depreciation can be claimed as a deduction against the rental income each year. Now, the benefit of that, of course, is you get the marginal tax rate, and it may be 47% if you earn over 180. Notwithstanding that, but on the sale amounts, when we come to calculate capital gains, the depreciation claimed has to be added back. Now that increases the capital gains overall to do the calculation, but you know, that's not too bad because then we've got the discount, and I'll talk about the discount a little later. So effectively, there is an advantage to get that depreciation schedule and claim those depreciations on it. Now, how to maximize the tax? There's a couple of tips that we can use. Firstly, you really got to maintain excellent documentation because at the moment, ATO is vicious. Recently, they sent us reminders to explain. They asked various clients. They just had a project on questioning the borrowing expenses for the 2012 year. And if you couldn't substantiate it, so that means if you couldn't prove where the figures came from and you didn't have substantiation, they disallowed it. But the worst part is, of course, they disallowed it because they put the onus on you to prove it. They didn't come asking. They just said, we're going to knock it out unless you can prove otherwise. So ATO, preferably do all the right things. So good documentation is essential. That includes the solicitor's settlement letters, the renovation expenses. When you buy and you do a lot of renovations and repairs, keep all those records. Put them on an Excel sheet or just scan them and keep them safe. And don't forget, you got to update your storage device because then, you know, you might lose them altogether. Keep a copy with your accountants. We usually keep a lot of these copies for clients, and recently for the clients that we had who were investigated and audited by the tax office, we were able to pass through immediately. Also consider taking out some audit insurance. That pays for the accountant helping you with all these things. Now the quantity surveyor's report and so forth, that always helps out. Sorry, I flipped that too fast. But look, the next item we should be looking at is, look, when is a property really exempt from capital gains tax? Now I'm ripping through these a bit faster than I had expected because I'm talking fast. So if you guys are having an issue with that, please email me or get onto the notes and we'll try and slow it down. But generally speaking, a property is exempt when it's the main residence. Now, you're only allowed one main residence at any one time. So that is a really important exemption. There are a few people there who get the opportunity to get into a property and fix it up, repair it, improve the value, decorate it nicely, and then later on, a few years later, they may decide the family has grown up or their taste has changed and they sell it. So any gain they have made on that is going to be totally free of tax. There is no capital gains tax. The other exemption, of course, is if the property is purchased before 19th of September 1985, which is when the legislation came into effect. Now, that is an important date because if you've got property that was bought before then, you don't just want to let it go. You want to plan very carefully around it because you won't get that exemption from capital gains tax again. And that's important for people who have property in a trust. If the property is sitting inside the trust and, of course, the trust changes control, as long as the trust does not change the beneficial ownership, that means the beneficiaries don't change, But in a discretionary trust, of course, there are a number of beneficiaries. For example, I was at an operation recently for my eye, and even the doctor was talking to me when he found out what I do, and he was saying, well, you know, my parents have aged, my father's passed away, my mother's in her 90s, we've got this property, I think it was 6 or 8 units in a very, very eastern suburb sort of location, quite valuable. Should I sell it or should I keep it? That was the question. Now my response was immediately, of course, mate, you're sitting on an eastern suburbs property and you have control over it. Why would you sell it now when you don't need the cash? And as has happened since last year, of course, when this all happened, the property has, you know, more than increased by 15–20%. Now, you know, that is where, and of course that's coming to him, not to his parents, because it's sitting through a trust, and now he controls the trust as a result. Now, the other part where the exemption applies is, of course, in a deceased estate. Okay, and we'll carry on. We'll ask a couple more things on the deceased estate in a moment. Now, just keep in mind that only one main residence is exempt at any one time. So, should you move from that property to another property, you have to make up your mind which one is going to be exempt. Now, that exemption, the government has allowed in the legislation some conditions to extend the exemption for people who get, let's say, posted overseas or for some reason or other decide to move away. But they don't have another property that they want to nominate as their main residence. So you can extend the exemption for another 6 years. What that means is if you sell the property anytime during those 6 years, there will be no capital gains no tax on the capital gains from there on. Moving forward onto that, of course, you've got the 6-year rules. Can be extended for 6 years, yes. You can extend the 6-year benefit if you reoccupy the property before the 6 years expire. What that means is this will get you another 6 years of exemption. Now, don't forget that what happens is if you don't come back and reoccupy the property, and if you don't nominate another property, when you sell it, that period will still give you some benefit, that 6-year extension, because of the property being your main residence. Okay? So that an example of that is where you establish a property first as your main residence, and then you lease it out for 6 years, and then you don't come back for another 2, which means it's been rented out for 8 years, and then you sell it at that point. Okay, so your exemption your capital gains will be exempt for a larger period of time. That means the period you occupied it and the period of the 6-year extension. There is a calculation to that, so consult your accountants and your property tax specialist to work all that out. And it's best to do it before you actually do things, not after. Now, let's talk about concessions. One of the major concessions surrounding the capital gains tax system is, of course, going to be the 50% discount on the calculated gain. Now, when is that available? Well, of course, when a property is generally held for longer than 12 months. Now, what you've got to understand that it's really important to persuade the government, the ATO, of what your intention is. So if your intention is to hold the investment to generate rental income, then it will be considered a capital asset and your 50% discount will be available. But if your intention was always to sell it or rent it or is always to sell it at a profit, then it doesn't matter whether it's held for 12 months or more, you will still be taxed without the 50% discount. Okay? So look, we'll try and do another poll for you now, and let's start with some of the facts. A property was first established as a rental investment and then as a main residence. and then it was occupied as a main residence. How is the CGT treated? Exempt or taxable? Or is it apportioned? Okay, we're going to run this poll now and give you just a few seconds to answer that. And the next poll, of course, is my assistant here shows me this one. Push it down, pick up. Here's the second poll, and we launch it. All right, and you've got a few seconds to respond. Okay, there's a few said exempt, few said taxable, and most people have said apportioned. Okay, so we'll close that, right? We'll close it, and we'll share the screen back on. Okay. Yes, I'm being pointed to something here. Oh, hide it. Yes. Okay, so now you've got the screen back on, hopefully. Okay, so a lot of these situations arise from where you've got a rental. You establish a property as a rental, and then you transfer or you occupy it, and it becomes a main residence. And the other situation is where you establish it as a main residence and then convert it to be a rental. Or you start it off as a main residence, then make it into a rental, then back into a main residence. Of course, the answer to that question was it's apportioned. Okay, so the capital gains will be apportioned over the period. And there is a bit of a complex calculation, but generally speaking, if it was established as a rental, then immediately it's assumed that capital gains will be calculated. So you establish the capital gains, sales minus the cost base, and then you work out how long it's been occupied as a main residence. We eliminate that as a proportion, and the balance is, of course, subject to capital gains tax. Now, just remember that capital gains is, in fact, included as part of the income overall. In your normal tax returns. The 50% after the discount is added on to the things. Now, a lot of people ask me about rollovers, and the impression is that if you've created a capital gain and then you go and buy a larger property, you can roll over the gain into that property and avoid capital gains tax. That is not correct. Capital gains from one property cannot be rolled over when purchasing a new property. The cost base is only rolled over on situations of marriage breakdown or inheritance, right? Which gives us a nice segue into talking about the capital gains tax and inheritance situations. Where the main residence of the deceased, where there is the deceased, where the inheritance happens to be the main residence of the deceased, there will be no capital gains tax if it is sold within 2 years of decease. Generally, that's enough time to get probate and so forth. Now, that exemption will continue if the beneficiary continues to occupy it as the main residence. So it just stays on as a benefit. If it's not occupied as a main residence, of course, the cost base for the property will be the market value. Okay, so you've got to get a valuer to give you that. Now, a lot of people ask me, should I do it straight away or can I do it later when it's sold? Look, the valuers, generally speaking, use the statistics available to get a valuation for you at any time. There is tremendous amount of publicity, statistics rather, all around. Now, capital gains tax and inheritance, where the property is actually an investment of the deceased, then the beneficiary will inherit the same cost base that the deceased have. That means if it's acquired before September 1985, the cost base is deemed to be the market value on the date of decease. But if it's acquired after September 1985, the cost base will be whatever the deceased has paid for it. Now, moving on to another area, a few people keep asking me about land. They buy land. It's usually held for quite a long time, and you incur expenses in maintaining rates and so forth. Now, the cost base on non-income producing land includes pretty much the same things we included before, which is your purchase price, stamp duty, legal fees, and so forth. But in addition, you've also got rates, land tax, interest expenses on the loan, and maintenance costs. Now, all of these things are added onto your cost base, and that's good because then it increases your cost base, reduces your capital gain. You're not taking any of these expenses as a deduction against income because there's no rental income. Now, that's the same applies where you've got holiday houses. You know, you keep the holiday house out there. You don't generate any income from it, at least none that you know of, and you know, you got to add all these things. So just a couple of tax tips to help you with that sort of situation. You've got to have the capital gains is only payable. No, I'm sorry. I'm going to just step 2 steps back, okay? And you've just got to keep records for these things, the rates, the land tax, the interest, and the maintenance cost. Okay, take a pause down here, and then we'll go on to some tax tips. Look, some of the important things to note is capital gains is really only payable if there is a sale and if there is a gain. Right? Now, the implication is that the gain generally starts to take you into a higher marginal tax bracket. So that's when you'll be paying tax. But if there's no sale, there won't be a tax. You don't need to worry, but you do need to plan. And later on, we've got an example where it will highlight some of these issues, right? But let's move on to, we already mentioned that main residence is one of the major benefits, the exemption from that. So a lot of people will come and ask me and say, look, you know, I bought the house, I lived in it, you know, while I was repairing it, and now I moved out, got a rental. Is that going to be established as a main residence? Well, look, some of the issues or some of the conditions that establish a main residence as a main residence, which will be exempt at the beginning, is first you've got to occupy the dwelling. You've got to occupy it. You've got to live in it. Another test that the ATO looks at is whether your family also lives there, and whether you moved in your personal belongings, because sometimes people want to call it their home, but they haven't even really moved things in. If whether your the address has been changed, and that's where you're receiving all your your mail, and you've got also whether the address on the electoral roll has been changed to reflect that address. You've connected all the services, phone, gas, electricity, and so forth. And again, as we mentioned before, it's intention. So if the ATO usually looking at when they're in a dispute with you, they're looking at your facts in hindsight. So they know more than what you were making your mind up at that time. So intention is important. So if your intention is to occupy the dwelling, then that should be reflected in the facts. Now, the length of time you live there is also a consideration. I'm always asked about how long I should be in there before it's considered my main residence. Look, there is no fixed rule. There's no minimum, but preferable from my analysis, I'd like to see 6 to 12 months. 12 months because it goes over that 12 months period for allowing the 50% discount should things not quite go your way. The ATO does mention 3 months in some of their material on the web and other locations. But look, we at this point, what we can do is mix all those facts that we've just discussed into a case study to try and highlight it. Now, the facts of the case study come up like this. We've got Julia. She buys a distressed 3-bedroom property in 2009 on the Sunshine Coast for $400,000. The current value is now $700,000. Mind you, this is a live case. I have worked through this exercise with the client, so while all the facts are not the exact ones, the principals are. Okay, but it illustrates your situation. Julia had established this property, the Sunshine property, as her main residence, was soon immediately after purchasing it. Now then she's occupied it for 2 years. After that she had to move to Sydney for work. While she was in Sydney, she buys a 1-bedroom unit in 2011 for $400,000. Right now the value is $500,000. She establishes that as her main residence at that point. So she actually occupies the property and puts her name on the electoral roll and so forth and so on. Establishes all the services. Now at this point she wants to sell both properties to fund a third property from where she can work, because the 1-bedroom property in Sydney was too small. So the questions are going to be, how much CGT is payable? The Sunshine Coast property and the Sydney property, which one should be nominated as the main residence? So this is your question for poll number 3. And we're going to run it right now, as my assistant is going to show me where the polls are. Yep, I'm going to click on the arrow. So you've got the facts, and we've got to launch it. Yep. Okay. So the question is going to be, which one should be sold? How is the capital gains tax going to be minimized? Right, I can see you guys doing, we've got a lot of people, yes, we're nearly at 100% there. So 37% said Sunshine Coast, 33% said Sydney, 29% or 27%, that's changing now. Okay, 45% said Sunshine, 28% said Sydney, and 28% said apportioned. Okay. Which residence should be nominated as the main residence? Okay, let's. I'll close it now, and I will share the screen back with you, and we'll go through the. I'm sorry, I'm just getting some technical here. Hide. We go to hide. Right. Okay. So we're back in action, I understand. Sorry guys. So which one should be nominated as the one for the main residence? The Sunshine, Sydney, or both on a apportioned basis? And we've done the poll, and the answer is, of course, Sunshine. Now, why is it Sunshine? Let's consider the details. The capital gains on Sunshine is 300,000. It's 700 minus 400 gives you 300,000. If you take the 50% discount out, that leaves you with 150,000 to be taxed. And this particular client happened to be earning over $180,000, so her marginal tax rate is going to be 45% plus 2% for Medicare, and now of course there is 2% debt levy. But we'll stay without the debt levy for the time being. That makes the tax for $70,000. Okay, and so what we've got is the capital gains tax on Sydney instead is going to be only $100,000. With the 50% discount, of course, the taxable component's only 50%. At 47%, that's only $23,000. So, what's our tax tip? Well, firstly, the time to nominate which property as the main residence is at the time of sale. So for this particular example, we need to compare how much capital gains tax is payable. The exemption can be extended to 6 years. So we're going to nominate as the main residence the one with the highest capital gains tax liability, to practically just to exempt it. So the case study alternatives we've got is nominate the Sunshine Coast as the main residence. We save $70,000. But if we nominate the Sydney as an investment, we save $23,000. Forgot the K on the 23 there. But the point is, if you do apportion it, then you're going to get somewhere in between. Okay? But if you just nominate the Sunshine Coast and it falls within the 6-year extension, 6-year extended exemption rule, then you're saving $47,000. Now, I'd say that's a worthwhile exercise. And timing. You got to work out your timing because that's important. Another tax tip relating to timing is timing of the sale can help you minimize capital gains tax. So it's not just choosing which property to nominate as your main residence is an issue. You can also time the sale to help you minimize it. How? You can, the contract date is the relevant date for calculating capital gain, and it's not the settlement date. And so if you're signing a contract in July, it can defer the tax payment for up to 18 months. Now, during that time, you can do a lot of things, particularly the share traders. They can turn the money over pretty quickly. Now, where we've got the, you can also try and match your capital gain with a capital loss from another asset. So if you're hanging on to shares that didn't go anywhere, that have lost, I've certainly lost some money on BHP, and should I have a capital gain, I would sell BHP now to crystallize it. So because you can only offset capital gains against capital losses against capital gains. So I don't really want to pay tax on capital gains in 1 year and have the losses come up in the next year. You want the losses in the same financial year. Okay? All right. Well, look, from this on, I get a lot of questions next on subdivision. Okay? What is the capital gains tax related to subdivision? I'm not going to do a lot on subdivision, but I'm just going to go the basics to just explain where we're going with that. The most important thing with subdivision is, of course, intention. Intention is really the magic ingredient which dictates how a gain from subdivision is taxed. Right? Subdivision is not really formally recorded anywhere. But in case of a dispute with the ATO, you would really need to have something in writing which can prove your point. If you do write it and then you don't want to use it, that's fine. So intentions can include realizing the capital gain in the property or profit-making purpose. Now, the realizing the capital gain in a property, the gain is going to be of a capital nature. You are eligible to receive the 50% discount, and it's just considered a mere realization of the capital. Where does that happen? A lot of the times that happens when people are buying a block of land or an investment property, and they see potential for it, and so they go subdividing it. Okay, so they subdivide it, they sell the vacant block, and they keep the other investment property. They take the gain and reduce their loan on the other one. That will be considered a mere realization of capital. Now, what you've got there, of course, is you've got to remember your cost base will also be for that land, will be the not exactly 50% of the cost of the purchase price, because the vacant land will be worth a little less than when there is a dwelling on it. So a valuer will give you that information. You'll also add all the costs of the DA applications and so forth, and that'll be a portion between the two blocks. And then that'll be compared to your sale price overall. But on the other hand, should you decide that you are going to realize a profit by having a development, and you go constructing things on it, then you're considered to be carrying on the business of property development. And as such, any gain you made are just going to be added to your tax return as business income. There is no 50% discount. The other drawback is if you construct something new, GST, as you know, is only applicable on brand new property. There's no GST on used property, only on brand new property. If you happen to do also a renovation that is so big that it deems the property as new, then GST will apply also on the sale. Okay. Now, a couple of examples on that is that I've had clients come and ask me, they want to do duplexes on properties, so they knock down the property and they put a duplex. But by the time we do the calculation, the after-tax result is worse for the development than it is if you simply sold the land with getting the 50% discount on it, and then later on at some time you sell the other side. Okay? Because, you know, here you're going to pay tax at the marginal rate, and the second part is you're going to get up with GST. Look, we're going to do another poll now, and here are the facts for that poll. This is the last one for the day. So if you don't like these things, well, this is the last one, but, you know, they're a bit of fun when I sit there on the other end. Demolishing the main residence. If you buy a main residence or a property and you establish it as your main residence and you demolish it and you sell it as vacant land, no, I beg your pardon. Yes, demolishing the main residence and selling the vacant land will not be entitled to the main residence exemption. Is this true or is this false? Okay, so this is going to be a much false, yes. Click it here. This is the last one. All right, and I'm going to launch it. Okay. All right, it's coming out your way. What's happening there? Is it coming up? All right. So 50% it's true, and 54, no, I guess still going more here. Changing. There's a little bit more. All right, 67% have voted. Okay. A few more seconds. I've got to learn the technology on this thing to see where these timings are. Okay. All right. Well, we'll then close the poll at the moment. We had 40% saying true and 60% saying false. Okay. And now we're going to share the screen with you again. And hopefully that is coming through. And of course the answer is that it is true. Okay. Now just remember that if you do buy a property that you establish as your main residence, do not knock it down before you sell it. You sell the vacant land. And the reason for that is, once you've knocked down the dwelling, which is supposed to be your main residence, then you've changed the character of the property. And you're going to be selling land, not a main residence. So you will not receive any exemption from capital gains. You're going to be taxed on that land, particularly if it's very valuable, particularly if you've owned it for 20 or 30 years. So do not knock it. Get your planning all done before. This is what it leads me to here. This is your advice. Before you do any action, it's really important to calculate the economics and the cash flow of the proposed transaction, and then discuss that strategy, plan the structure that you're going to use and the exit strategy. Get professional advice, for Christ's sake. You know, because, you know, why do you need professional advice because, listen, how much will it cost you if you get it wrong, such as in the example I just gave you? Now compare this to the cost of good advice. Right? That's not a lot. Now look, this is probably at the end of our presentation, but I'll take a couple of questions because we've got a few more minutes. But what I'd like you to do is just when you're searching to get advice and support, to make those important decisions, well, consider us. We're more than happy to help out. And as a webinar special offer today, we've come up with we can give you an initial consultation of up to 2 hours for only $450 flat fee. And that's a saving of $650 from our normal consulting fee of $550 per hour. You've got to take that offer until the offer is open until the end of the week. Okay. I look forward to being of service. Now, this is our website. There is a number of materials there, and we're at the moment we're working on some more things to add in terms of content. There'll be a couple of newsletters. We're planning one on land tax, and we're going to answer a lot more questions on capital gains for you as well. Now, we're going to try and find I'm just going to find where the questions are coming from. Okay. Oh, yeah. Okay, I'm just having a quick look at that, and we'll come up right up the top. And what are some short CGT? Is one of the questions is, what are some short-term CGT reduction plays? I have 9.5 weeks left in my CGT year. I will need to pay in early March. Okay, well, I think we've said some of the things. If you've already sold the property and your capital gains tax is there, there's no way to avoid that. Graham, I'm sorry. You've got the gain. Tax return has to come in. There's no way to delay that. Okay. Oh, my voice is muffled. All right, I'm sorry about that. That was coming from Sunny. I'm sorry, Sunny. I tried to be as clear as I could. Hi, I bought my investment property for $88K in 2000 and sold it for $185. I lived in it for 2 years and have rented out for the past 11 years, or 12 years done for renos to the value. Okay, I think I've explained that. The renovation costs add to the cost base, and it's just a matter of calculating the tax. Okay, the next question here is going to be from Jess. Will you be talking about renovating for profit scenarios? Jess, yes, I can talk very briefly on that. Renovating for profit. This is where you buy let's say the worst house in the best street, and you go in and do a renovation, similar to what Cherie Barber talks about, and then either rent it out or sell it. CGT reduction plays. I have 9.5 weeks left in my CGT year. I will need to pay in early March. Okay, well, I think we've said some of the things. If you've already sold the property and your capital gains tax is there, there's no way to avoid that. Graham, I'm sorry. You've got the gain. Tax return has to come in. There's no way to delay that. Okay. Oh, my voice is muffled. All right, I'm sorry about that. That was coming from Sunny. I'm sorry, Sunny. I tried to be as clear as I could. Hi, I bought my investment property for $88K in 2000 and sold it for $185. I lived in it for 2 years and have rented out for the past 11 years, or 12 years done for renos to the value. Okay, I think I've explained that. The renovation costs add to the cost base, and it's just a matter of calculating the tax. Okay, the next question here is going to be from Jess. Will you be talking about renovating for profit scenarios? Jess, yes, I can talk very briefly on that. Renovating for profit. This is where you buy let's say, the worst house in the best street, and you go in and do a renovation, similar to what Cherie Barber talks about, and then either rent it out or sell it. CGT reduction plays. I have 9.5 weeks left in my CGT year. I will need to pay in early March. Okay, well, I think we've said some of the things. If you've already sold the property and your capital gains tax is there, there's no way to avoid that. Graham, I'm sorry. You've got the gain. Tax return has to come in. There's no way to delay that. Okay. Oh, my voice is muffled. All right, I'm sorry about that. That was coming from Sunny. I'm sorry, Sunny. I tried to be as clear as I could. Hi, I bought my investment property for 88k in 2000 and sold it for 185. I lived in it for 2 years and have rented out for the past 11 years or 12 years, done for renos to the value. Okay, I think I've explained that. The renovation costs add to the cost base, and it's just a matter of calculating the tax. Okay, the next question here is going to be from Jess. Will you be talking about renovating for profit scenarios? Jess, yes, I can talk very briefly on that. Renovating for profit. This is where you buy let's say, the worst house in the best street, and you go in and do a renovation, similar to what Cherie Barber talks about, and then either rent it out or sell it. CGT reduction plays. I have 9.5 weeks left in my CGT year. I will need to pay in early March. Okay, well, I think we've said some of the things. If you've already sold the property and your capital gains tax is there, there's no way to avoid that. Graham, I'm sorry. You've got the gain. Tax return has to come in. There's no way to delay that. Okay. Oh, my voice is muffled. All right, I'm sorry about that. That was coming from Sunny. I'm sorry, Sunny. I tried to be as clear as I could. Hi, I bought my investment property for 88k in 2000 and sold it for 185. I lived in it for 2 years and have rented out for the past 11 years or 12 years, done for renos to the value. Okay, I think I've explained that. The renovation costs add to the cost base, and it's just a matter of calculating the tax. Okay, the next question here is going to be from Jess. Will you be talking about renovating for profit scenarios? Jess, yes, I can talk very briefly on that. Renovating for profit. This is where you buy let's say, the worst house in the best street, and you go in and do a renovation, similar to what Cherie Barber talks about, and then either rent it out or sell it. CGT reduction plays. I have 9.5 weeks left in my CGT year. I will need to pay in early March. Okay, well, I think we've said some of the things. If you've already sold the property and your capital gains tax is there, there's no way to avoid that. Graham, I'm sorry. You've got the gain. Tax return has to come in. There's no way to delay that. Okay. Oh, my voice is muffled. All right, I'm sorry about that. That was coming from Sunny. I'm sorry, Sunny. I tried to be as clear as I could. Hi, I bought my investment property for 88k in 2000 and sold it for 185. I lived in it for 2 years and have rented out for the past 11 years or 12 years, done for renos to the value. Okay, I think I've explained that. The renovation costs add to the cost base, and it's just a matter of calculating the tax. Okay, the next question here is going to be from Jess. Will you be talking about renovating for profit scenarios? Jess, yes, I can talk very briefly on that. Renovating for profit. This is where you buy let's say the worst house in the best street, and you go in and do a renovation similar to what Cherie Barber talks about, and then either rent it out or sell it. CGT reduction plays. I have 9.5 weeks left in my CGT year. I will need to pay in early March. Okay, well, I think we've said some of the things. If you've already sold the property and your capital gains tax is there, there's no way to avoid that. Graham, I'm sorry. You've got the gain. Tax return has to come in. There's no way to delay that. Okay. Oh, my voice is muffled. All right, I'm sorry about that. That was coming from Sunny. I'm sorry, Sunny. I tried to be as clear as I could. Hi, I bought my investment property for 88k in 2000 and sold it for 185. I lived in it for 2 years and have rented out for the past 11 years or 12 years, done for renos to the value. Okay, I think I've explained that. The renovation costs add to the cost base, and it's just a matter of calculating the tax. Okay, the next question here is going to be from Jess. Will you be talking about renovating for profit scenarios? Jess, yes, I can talk very briefly on that. Renovating for profit. This is where you buy let's say the worst house in the best street, and you go in and do a renovation similar to what Cherie Barber talks about, and then either rent it out or sell it. CGT reduction plays. I have 9.5 weeks left in my CGT year. I will need to pay in early March. Okay, well, I think we've said some of the things. If you've already sold the property and your capital gains tax is there, there's no way to avoid that. Graham, I'm sorry. You've got the gain. Tax return has to come in. There's no way to delay that. Okay. Oh, my voice is muffled. All right, I'm sorry about that. That was coming from Sunny. I'm sorry, Sunny. I tried to be as clear as I could. Hi, I bought my investment property for 88k in 2000 and sold it for 185. I lived in it for 2 years and have rented out for the past 11 years or 12 years, done for renos to the value. Okay, I think I've explained that. The renovation costs add to the cost base, and it's just a matter of calculating the tax. Okay, the next question here is going to be from Jess. Will you be talking about renovating for profit scenarios? Jess, yes, I can talk very briefly on that. Renovating for profit. This is where you buy let's say the worst house in the best street, and you go in and do a renovation similar to what Cherie Barber talks about, and then either rent it out or sell it. CGT reduction plays. I have 9.5 weeks left in my CGT year. I will need to pay in early March. Okay, well, I think we've said some of the things. If you've already if you've already sold the property and your capital gains tax is there, there's no way to avoid that. Graham, I'm sorry. You've got the gain. Tax return has to come in. There's no way to delay that. Okay. Oh, my voice is muffled. All right, I'm sorry about that. That was coming from Sunny. I'm sorry, Sunny. I tried to be as clear as I could. Hi, I bought my investment property for 88k in 2000 and sold it for 185. I lived in it for 2 years and have rented out for the past 11 years or 12 years, done for renos to the value. Okay, I think I've explained that. The renovation costs add to the cost base, and it's just a matter of calculating the tax. Okay, the next question here is going to be from Jess. Will you be talking about renovating for profit scenarios? Jess, yes, I can talk very briefly on that. Renovating for profit. This is where you buy a let's say the worst house in the best street, and you go in and do a renovation